Now I'm just re-recording these things. Allowance method, not followed, allowance method followed. When allowance method is not followed for the sale, debit accounts receivable, credit sales or revenue, 100,000, 100,000. Debit accounts receivable 100,000. Credit sales or revenue 100,000. For creation of allowance, here we are not following allowance, so no entry. For creation of allowance, here we are following the allowance method, so that the entry is debit bad debt. And credit allowance for credit losses. This is contra asset account. We created 3%, that is 3,000. This is income statement. This is contra asset account. So next, what happened in the same year or next year, whatever it may be, subsequently what happened, the actual bad debt arrived. Bad debts, actual bad debts written off. When actual bad debts written off, we will debit the income statement with the bad debts. And credit the accounts receivable. This is permanent decrease in accounts receivable. Here, there is a permanent decrease in accounts receivable. So credit accounts receivable. When we created the bad debts, allowance for credit losses we credited here, not accounts receivable. So when actual bad debts arise, actual bad debts written off, in that situation only accounts receivable is debited. So in place here, we already credited allowance for credit losses. Now we are cancelling that allowance. So debit, we should not debit again bad debt. Why? Because income statement is already debited as per the matching principle. So here we will not debit again bad debt. We will cancel this allowance for credit losses. So here what will happen? Here in income statement, bad debts, it might be 2021, it might be 2020. If 2020 there is no mismatch, that's okay. So sometimes what will happen, bad debts may arise in next financial year. So bad debts we will record here 2,000. And in balance sheet, from the accounts receivable, we will deduct this 3,000. Assuming there is no other credit sales, 2,000, 98,000. But whereas here, allowance for credit loss account and accounts receivable account. So when allowance for credit loss is already showing 3,000 balance, 2,000 we have used because of the bad debts, and this allowance for credit loss is still 1,000, that's contra asset account. And accounts receivable here 100,000, because of the 2,000 bad debts loss permanently decreased. So now accounts receivable shows 98,000 here. So that's why when we show income statement, it not affects the income statement, this entry, actual bad debts. However, the balance sheet will be shown as accounts receivable 100,000 minus, simply what we will do here, this bad debts written off permanent, that is 2,000, 98,000, and minus allowance for credit loss now is how much? 1,000. 1,000 will be deducted, 97,000. Here also there is no effect in the balance sheet as such. Here also the balance sheet, here when we create this, here balance sheet, accounts receivable 100, allowance for credit loss 3000, so it is 97,000. So net effect after the bad debts also the same, 97,000. So there is no change when the bad debts actually written off. Now what happened in subsequent financial year? We have received the amount. Bad debts, previously written off bad debts now collected. Previously written off bad debt now collected. So what should be the journal entry? How it will be recorded when we are not following allowance method? When we are following allowance method. When we are not following allowance method, simply what we will do, we will debit the cash and credit the bad debts recovery account. Debit the cash, bad debts recovery account, we will write. So this is gain in income statement. And this is the current asset is increased. In allowance method, what amount we are going to consider and how the journal entry will be recorded when allowance is collected. I mean to say previously written off bad debts 2000 now collected. When previously written off bad debt is now collected, we restore the allowance account. Previously we have recorded entry what? Debit allowance for credit losses and credit accounts receivable. This entry we will reverse. We are getting accounts receivable increased 2000 and we are restoring the allowance for credit losses. Allowance for credit losses 2000 will be recreated. And then what we will write? We will write cash account debit. And this accounts receivable will be credited. So credit accounts receivable. So finally, what is the effect? Finally, what is the effect? 2000, 2000. There is no effect on your income statement. Already income was shown in 2020. Now, even after the bad debt recovery, there is no effect on the income statement. So matching principle same as it is followed. There is no disturbance to income statement. And when we see allowance for credit loss account, previously it was created 2000, then bad debts written of 2000, there was allowance of 1000. Now when the bad debt recovered in subsequent year, here accounts for allowance for credit losses increased by 2000. So again it is 2000. So that net effect of allowance is again is 3000. And accounts receivable, when you personally accounts receivable, it was 98,000. Now it is restored with 2000. So account receivable will be 100,000. When you see the balance sheet, in this case, what will happen? The accounts receivable 98,000, add additional accounts receivable restored, it is 100,000, then less allowance for credit losses 3000, again 97,000. Neither bad debt recovery affected your accounts receivable, neither bad debts written off affected your accounts receivable. What was the status? We created in the first place accounts allowance for credit losses, same 97,000 here. When actual bad debt arise, same 97,000 here. When bad debt recovery is made, same 97,000 here. So this is the concept of recovery of bad debt. Do you have any doubt? Ask me. Otherwise, we'll go to the question now. Is this clear?
Yes, sir.
Adil, Mustafa bhai, Shiva, Payal, Rajat.
Yes, sir.
Yes, sir.
Okay. So when allowance method is there, when bad debt recovery is there, we will write cash to bad debts recovery. Here also we can write accounts receivable. We can write accounts receivable to bad debts recovery, debit accounts receivable, credit bad debts recovery. And then again we will write what? Credit cash, sorry, debit cash and credit accounts receivable. Here also we can write net effect is what? Net effect is increase in cash, current asset, and increase in income. That's the point. We can write like this. In this way also we can record. Sensible accountant will record. For audit trial, this is useful. From where this we have received, which person this is received, that record will be there. In allowance method, simply increase the accounts receivable 2000, and to that extent allowance for credit losses will be credited. We are not going to touch income statement here. Here we are not touching income statement. Here we are touching the income statement. Bad debts recovery. Why? Because if you are recording again 2000 in income statement, already you have recognized revenue there 100,000. Okay. So that is again double effect will be there. So as usually the above entry for cancellation of accounts receivable, entry will be reversed in this case in the allowance method. And when cash received, cash account data to accounts receivable. So one asset is increased, one asset is decreased. Net effect on current asset is 0. That is what the concept of this. Now we'll go back to the question. Now you may answer me this question. A company uses direct write-off method account for uncollectible accounts receivable. If the company subsequently collects an accounts receivable that was written off prior accounting period, the effect of collection of accounts receivable on the current ratio and total working capital. What is happening when we are accounts receivable allowance method is not followed? But
answer A, sir. Answer A.
But accounts receivable written off prior now collected. What is happening? What is happening? What is the entry? Bad debts, accounts receivable, sorry, cash debit and credit bad debts recovery account. So what is the effect is happening? Cash is increased. Cash increase means current asset is increased. Current asset means increase means current ratio will increase. So current ratio will increase. Okay. And what is the working capital? Working capital is nothing but what? Current assets minus current liability. When current asset is increases, working capital is also increases. What is the answer? Payal? A is the answer. Shiva, are you clear?
Yes, sir.
Rajat, are you clear?
Yes, sir.
A company uses allowance method to account for uncollectible account. An uncollectible receivable that was previously determined uncollectible and written off was collected during May. The effect of collection of company's current ratio. Is there any effect on current ratio?
No effect.
No effect. What about the working capital? What about
Increases.
the working capital?
If current asset is not changes, working capital will also not change.
Not change. Why? Because current asset minus current liability. So net accounts receivable same 97. When provision created 97, when bad debts written off 97, when bad debts recovery 97. Is there any change in current asset? No change.
No.
So that's why what is the answer here?
C.
C.
Is the answer. Mustafa bhai understood?
Yes, sir. Yes, sir. Sorry. Yes. Answer is C. Correct.
Rajat, clear?
Yes, sir.
Mahmood?
Yes, sir.
So this is what the concept of allowance method and non-allowance method. This much of background is needed to understand this concept.